Behind the Ticker is brought to you by UX Wealth Partners. If you're a TAMP user and you're sick and tired of the legacy technology they are run on and you want more customization and flexibility, as well as a AI-driven model marketplace, UX Wealth Partners is your destination. On top of that, they have institutional trading. So if you are an ETF issuer or an SMA provider looking for outsourced institutional trading, UX Wealth can also be your destination. So check out uxwp.com to find out all the ways UX Wealth Partners can help grow and make your practice more efficient. Welcome to Behind the Ticker. Today we have on Mike Venuto. He is from Tidal, the ETF Masters, and they are one of the premier white labeling ETF shops in the market. If you're looking to start an ETF, if you're looking to find out more information about starting an ETF, Tidal is a great place to start. I would highly recommend a conversation with somebody from their team. But today we're talking about all things ETFs, mostly current events, what's going on, talk about some regulatory things, talk about, the market as a whole, what is being launched, what do we think is going to be launched next, kind of everything ETFs. So if you're an ETF nerd like myself and maybe Mike, then I think this episode will be interesting for you. So please enjoy this episode with Mr. Mike Venuto. Hey, Mike, welcome back to the show.
Yeah, good to be back.
So why don't you just take a couple minutes, refresh everybody who you are, and tell everybody a little bit about Tidal and your background.
Sure. So my name's Mike Venuto. I'm the co-founder and CIO of Tidal Financial Group. Primarily, we help people launch and grow and operate ETFs. We've done it now right now I think there's 162 funds that we're servicing on our platform. As the CIO, I also get involved with a lot of structuring as well as actively managing a few funds for our clients. The last time I was on your show, we talked a lot about BLOK. That's one of my passions. Recently, it took over managing NANC and CRUZ, which has been a lot of fun. Basically, we are a platform that can help you launch, grow, and operate ETFs. And we do everything from, kind of that boring compliance work to fun active management, as well as creative marketing, all that fun stuff.
Well, while you mentioned it, how is BLOK going? And just like maybe a little bit of an update there. And it would be neat to hear. I think the listeners would enjoy hearing, like, how do you go about finding and placing trades for NANC and what's the other one, CRUZ?
CRUZ, yeah. Okay, so both BLOK and NANC and CRUZ I manage with Dan Weisskopf and the rest of the investment committee. We actually have specific meetings for each fund, and then we have a 15-person investment committee that meets every Monday and covers not just the active stuff, but also the passive stuff. We also actively manage YMAX, which is the fund of funds for the YieldMax family. A lot of it's tax optimization, all that fun stuff. So we'll hit BLOK first, and then we'll get a little bit into NANC and CRUZ. With BLOK, we're extremely active. I mean, we've owned IPOs, we've owned convertible debt, we've owned Bitcoin through Canadian ETFs, then through US ETFs. We have Dan on the Bitcoin Mining Council. We speak to Saylor all the time, Novogratz's crew, all the miners. So it's very much an understanding of the ecosystem, right? You can talk to all the blockchain companies you want. They're all going to tell you their story. But really where you get into the weeds and get to know things in that ecosystem is by asking about the supply chain and who they're buying chips from and who they're storing with and all that. So BLOK is having an extremely good year. Not a surprise considering, the underlying commodity of Bitcoin has had a pretty good year as well. We're up north of 25% as of this recording, which is, I would say, a pretty good year. NANC and CRUZ are very different. We're not meeting with management. We're not making a call on the business. What we're doing is we have a research agreement with Unusual Whales. And the partner in that is this company called Subversive, who set up everything originally, and then they brought us in to actively manage it. When they were managing it in the previous iteration. It was extremely diversified. One fund Nancy had 700 stocks plus, and CRUZ was like 400 plus. When we took over, Dan and I as managers, we decided to work with Oscar over at Unusual Whales, really partial through the data and really hone in on patterns that are true signals. What I think, if you just take the data and look at everything they own, well, some of these people hire, parametrics to do direct indexing for them. They don't really care about those 3 shares of Estee Lauder. They don't really have any insight, but it gets thrown into the mix. So we've really tried to consolidate down into names where we see a pattern of multiple people buying or somebody on a specific committee that might have some information. But for those who don't know, these 2 funds basically take the Stock Act, which requires that congressional members disclose what they've purchased. The irony is congressional members are allowed to make investments in things where they would for otherwise call inside information, right? Like there's really no way to sugarcoat it.
Right?
There's no other way to say it. They're legally allowed to make investments based on information that they receive that is not public to the rest of us. There's some notable people out there that, Twitter has pointed to. So the idea with Nancy is NANC is to track the patterns and disclosures of members of Congress that are in the Democratic Party. And then CRUZ does the exact same thing, but it's members of Congress that are in the Republican Party. This year, Nancy is outpacing CRUZ, but they both have very nice, diversified returns for the year.
We could probably do a whole episode on those 2. I remember when they first came out, and I got a good laugh out of it. I didn't know you guys took them over, so I'm glad you brought that up. But let's pivot back to Tidal.
Sure.
We got our friends over at Gregory FCA said, "Hey, Tidal is rebranding." I'll use that term loosely to the ETF Masters. So, what is that all about?
Yeah, it's a tagline, obviously, but the whole point of it was the experience, right? Like before doing Tidal, I was at a hedge fund. We saw ETFs as a threat. That's when I got involved with Wisdom Tree, became an angel investor there. Then angel investor, helped start up Emerging Global. Then I went over to Global X, head of investments there. Guy was at Global X with me, doing strategy. You had Eric Falkeiss at U.S. Bank and then Direction for many years, building those platforms. We brought over Gavin from Barclays. This guy had to deal with VXX for years. So the whole idea is Tidal became a master at this ETF stuff by making every mistake you can at other companies.
Right.
So the whole idea is if you come to us, we can help you launch, grow, and operate. And you've been through this, Brad. Pretty much everybody else stops at launch, right? And you kind of have to pull operate out of them and forget about asking them to help with growing, right? So that the concept of the ETF Masters is to convey that we've got the experience to help you not make the mistakes that we did in the past.
Yeah. So I guess that leads into my next question. So, I've talked to other white label firms. They're popping up all over the place. Like, what is it really at Tidal that kind of separates you guys from the others? Like some of those intangibles that, you mentioned and noted the experience, which is deep. But what are some of the things that you're really trying to do for clients to help keep them in the space and help them grow?
Yeah. So the numbers really speak to it, right? So there's over 165 funds on our platform. Over 19 billion in AUM. The funds that have been here over 3 years, on average, are $260 million, right? There is some survivorship bias there. We have a much lower open to close ratio than the overall industry. We have 75 employees dedicated to all of this. And that's not, like armies of people trying to get us business. The business is calling us all day long. If you want to launch an ETF, just look up Tidal. You'll find us. We'll help you do it. We have, lawyers on staff. We have the compliance on staff. We have people who will check your ads before they go to your distributor so that you don't get stuck at the distributor for 3 days. Like everything done here is to make the life of an issuer so simple that their job is to manage their portfolio, unless they've hired me or Dan to do it, and get their message out. Other than that, they shouldn't have to deal with anything. So that's really what makes it different. And you've been through this. A lot of us know how hard the ETF Terradome, as Eric Balchunas likes to call it, it's hard, right? So removing all the other barriers and headaches and then honing in on the most important part, right? So I mentioned we've got a lower close ratio than the overall industry. And that's because we don't just launch anything, right? If you come to me and say, I've got an idea to do the 27th, I don't know, cybersecurity ETF. I want to charge twice as much as the others. I want to be passive. And my niche is, well, I don't have one, but I'm willing to write you a check for 200 grand to do it. Sorry, the answer is still no. Right? We want product that's going to succeed. I want to keep that 3-year number in that 200 plus. That's success. That's what we look for. So, we're a platform that actually has a product development arm where we literally work with our clients to take concepts to the end and make them into things that are actually doable. Like that's how Yield Max that I mentioned earlier came about. That's how some of the new things we've been doing with Defiance have come about. Recently, we onboarded Cambria and Meb, and then we brought him a partnership with Jerry Parker to help him launch MFoot, the new managed futures fund. So everything we do is collaborative to get the product right, because that's the most important thing to the growth. And then once you got the product right, then we have all these amazing tools. We have Claire and this marketing team that, can provide all these ways to help grow the fund. And it's just, it's the kind of place where I wake up every day and like excited to be here.
Yeah, of course. It's funny. You mentioned I just interviewed Sylvia yesterday from Defiance. I noticed on your website you have a handful of your ETFs, of their ETFs are with you guys. And I did talk to Jerry Parker and Meb Faber on the show. So there's a lot of people using you guys to get product out to market. So you touched on all the things that you do. If someone's coming and using you guys in terms of, we'll call it a white label, are they going to get economies of scale because you do all of this stuff in-house rather than try to piece it together? Like, is there an overall, long-term cost savings kind of using all of your internal processes?
Absolutely. So, if you want to start your own ETF company and you want to start your own trust, you're looking at, depending on how good you can negotiate with your lawyers, somewhere between $250,000 and $1 million to start that trust. And it's going to take 6, 8, 9 months. That's kind of best case scenario. Right? If you come to us, most ETFs we can launch for under 70,000 and do it in less than 4 months. Unless it's complicated, at which point we're going to walk you through all those complications and get you there. Number 2, everything that's coming to market and succeeding right now, all the launches this year that are working are active. And not only are they active, they're complex. And complex means, like we said, Jerry Parker or Yield Max or Corey Hofstein with Return Stack. They're using things like options, derivatives, leverage. Sylvia just had the hit with the leveraged micro strategy, and they have leveraged Eli Lilly, all these things. All of those things require a program called 18F4. Okay, that's the derivatives rule. You have to have a VAR team. It's complex, requires expensive software. It requires high-end people who can explain it and report it on a daily basis. Do you want to do any product like that in your own trust? Add a whole bunch more expense, right? Like just pile it on, right? Then you got trustees, right? And you've got to have these meetings and you got to pay all these lawyers. So yes, but of course we'll have to edit that out.
That's fine.
You got all the expenses there, right? What we do that takes it an extra notch is we smooth all the bills out, right? So the title clients are on accrual accounting, meaning there are surprises every year that we can actually anticipate. A printing or an audit, the annual audits, the fees can go up and down like this every month. And, I had a fund at another white label one time. Good people, no complaints. But one month my bill would be 12 grand and the next month it would be 35. I don't want my clients living with that. I don't want them even ever paying me a bill. I want them to have funds that are break even, right? That's why we try and get the product right. But if there's small expenses, we smooth them out and accrue for them. So we want to make this so smooth that the only stress you have is how do I get more people to hear about my fund?
Yeah.
Oh, you go on Brad's show and tell your story, right?
Yeah. Yeah. I mean, I think we're on like episode 57. So like we've been pumping them out. And so, no, that's good. And it is true. Like we operate our own trust. I think you know that. And,
Mhm.
1 month, you pretty much have status quo. Then, you hit year end and you've got, listing fees, indexing fees, audits, your board, your annual board meeting that you got to pay, your board members and your travel and all the stuff. And like next thing you know, in August, you got a massive bill on your hand you got to plan for. So I know that all too well. You guys launched a lot of funds. Just in general, I believe did you launch like 32 funds last year? Is that right?
Yeah. I mean, and this year we're close to 60 that we've
Wow.
onboarded.
That's a lot.
And the pipeline for the rest of the year, I've got some exciting stuff coming out. Yeah. Obviously, that's the stuff I can't talk about because it's all in registration,
Right.
but I'm super excited about some of the things you guys are going to be seeing from the Tidal platform in the next couple months.
So without getting too, I guess so I'm trying to ask kind of a trends question here. Like what is trending? You had mentioned like active is working, but kind of what is trending? What are you seeing that people are trying to come to market with at this point in time?
So we kind of get our business from three different places, right? So the one is like traditional business development, going out and meeting people, going to Future Proof and or New York Stock Exchange events, and talking with folks that want to get into this business. And what we've seen as a trend this year in that, call it vertical, is larger institutions, right? So like they take longer to sit down with. The amount of giant name brands that we're speaking with right now that don't have an ETF presence that need to get in is amazing. We recently did Rockefeller. We have SoFi was one of our early ones, but you're going to see a couple of big brands from us in the next coming months. But that trend of I can't not have an ETF if I'm in asset management has now hit the larger level of institutions. Second trend we're seeing is clients that have had a successful single idea with us are now branching it out into a family. So they're going from product to business. Great examples of that: Corey Hofstein and Resolve with the Return Stack family. MEB at Cambria expanding the shareholder yield family. Yield Max, every day we're launching a new Yield Max fund and going to different places. My sleeper hit that I feel like I always have to give them love because it was one of my first clients, and everybody, it's like the greatest success story nobody's ever heard of. So there's this Sharia compliant RIA that we work with called SP Funds, our Sharia portfolios. When we met them, they had $80 million. They now have 4 ETFs with us, and then they have mutual funds as well, and like $750 million in Sukuk bonds and REITs. Like it's just under 4 years. It's amazing but that's the suite. They just keep building on it, making more components so that people who want to build Sharia compliant portfolios have all the pieces. I love that trend of clients going from product to business. And then the third one is conversions. We're talking to a lot of people who have a good idea. They've been managing it as an SMA, an LP, or a mutual fund, and they want to convert it to the best vehicle out there, right? Like we don't get guarantees in the world of finance, but I can guarantee, and I can say this, and the SEC can come bat me on the head if they want to, but I can guarantee that if you're a taxable investor and you're choosing between the same strategy in a mutual fund versus an ETF, 99% or 94% of the time, you're going to be way more tax efficient in the ETF. That's tax alpha.
Yeah, of course. And I think that's why we've seen the explosion that we've seen. We've also, staying on this, what do you think like the next wave will be? Like we saw, at least from my seat, you see a lot more than I do. Like I think we saw this wave of like defined outcome products. And then we saw this and a wave of thematics, and then a wave of single stock. Like what do you think that next like levered single stock, like what do you think that next wave might be as we kind of look over the next 24 months?
Yeah, so if we're talking 24, I think we're not done with the single stock stuff. I think that a lot of it is, so far with single stocks, you've seen leverage, inverse, and yield. I think there's 20 more things that can be done, and we're talking to a lot of people. There's also not just single stock, but concentrated, right? Like, Round Hill's done their Mag 7. There's micro baskets. I think Greg at Rex has done some stuff there. So I think there's going to be a lot of giving people trading vehicles that are associated with things that they're excited about. I do think that my friend Wes at Alpha Architect hit on something interesting with Box, right? Like, it does seem like there's this appetite for even more tax advantaged strategies than just traditional ETFs. Haven't seen anybody else do anything quite like it yet. I'm sure there'll be iterations, but I do think there's some opportunities there that could be a huge mega trend, because it certainly seems like taxes are going up. I do think you're going to see way more options, derivative, futures based. I mean, that fund that you talked to Jerry Parker about, that couldn't have been done 4 years ago.
No.
The rules changed, the regulations have opened the doors, and I think anything that's truly liquid in a mutual fund wrapper today is going to be in an ETF wrapper. I don't know that private credit is truly liquid. I know everybody just filed for that. We'll see. It's funny when a future proof, there was like 25 ETF issuers and like 5 or 10 mutual fund shops, but every one of those mutual fund shops had a private credit fund, which just smells like bubble to me.
Yeah. So you've mentioned mutual fund conversions a couple of times. Like, is that still a hot topic and a hot discussion? Like, we thought, or at least I thought, you were going to see the world of mutual funds just rush to ETFs, and it seems like a lot of managers kind of want to stay in that space for a variety of different reasons. But do you see that as a continuing trend? Like, I thought it would happen faster than it did.
Yeah. So who are the big success stories, right? DFA and JP Morgan, right? I think Wes has one success too with Chaos or something like that. And there was like one Neuberger fund that did well, or Alliance Bernstein fund that did well, but most of them haven't. So the question is why? Well, basically you're cutting off your captive distribution channel, right? You're in the Alamo and you're walking out, right? Like, it doesn't make a lot of sense for a lot of these mutual funds to convert. That's why you're seeing so much desire for the share class idea. I mean, that'll be a floodgates thing if the share class thing gets through. I think it's probably 2 years off, but who am I to say? We have done one mutual fund conversion, and it was thoughtful, meaning to convert a mutual fund, you want to make sure that the bulk of the clients have not paid loads, right? Because the platforms, they're counting on those loads, right? So we converted a no-load fund for Gotham. Now, this no-load fund happened to be a very active long-short portfolio with a short bias. In 2022, when the market was down, it had a spectacular year. But who's buying a shorting fund, mutual fund, because they got to hold it for 30 days? Right? These is more like a trading vehicle. So we converted that with Gotham over into an ETF structure. And one of the learnings of that is the conversion's not that simple, right? Like, it's easy to do, but if it's leaving somebody else's trust to come to yours, guess what? They can kind of charge whatever they want on the way out, right? So there's a lot of like nuances to getting this right. And we work with our clients on it. I'm a big believer that people should look at their mutual fund families and look through for commonality. So, you go look at the big brand, like guru, like mutual funds. They usually have 20 different mutual funds, right? And they're all different asset classes or market caps and things like that. But you'll find commonly that there's like 7 or 8 or 10, maybe 15 stocks that kind of end up in every portfolio, right? Because it's like they're darlings. So I always go to those shops and I say, no. Let's not convert your mutual funds. Half your assets are at Morgan Stanley or UBS. They're going to get upset and you're going to have to argue and then you're going to restart and all that. My suggestion to them is always, let's start the Founders ETF or your flagship ETF, right? And you make it a concentrated portfolio of your top picks, and then you buy that ETF in your mutual fund. So your large cap fund might buy 10% in the ETF, and your mid cap might only buy 5%. But some of those ideas are in every one of your strategies. Now you also get to pass that tax efficiency on to your mutual fund investors, right? Because if the ETF's not distributing gains, then you don't have to distribute gains from that mutual fund. So I love that idea. I think there's many different ways to go from mutual fund to ETF that aren't, let's pay lawyers 400 grand and
Yeah.
see what happens.
Yeah. You'd mentioned in there kind of the ETF share class. You think it's maybe 2 years away. Like, what is the current landscape and temperature around that ETF share class approval, and kind of just an update of where we are in that process?
Yeah, I mean, so what actually occurred? So Vanguard had it, right? They had a very specific one that only applies to passive, and it was all indexed, and um, the concept of the tax efficiency really wasn't fully understood when they got it. Their patent finally expired, and then everybody starts applying. The ones that are being applied for are a little more aggressive, right? They include active, they include shorting. There's all kinds of aspects to it that are a little bit different than the very simple version that Vanguard was doing, which, by the way, a lot of times the Vanguard one hurt, not helped the tax efficiency. I think that the regulators are going to be slow because they don't know the taxable impact and how much they're going to get gained. They're not going to be like, hey, let's just do this real quick and let this go since it worked for Vanguard. No, like this is, if all the people applying for this were identical to Vanguard, maybe it would get through quickly. But you're talking about active mutual funds that have gains built up in them that could be 20 years old with, $10 cost basis is on Amazon, right? And they're all of a sudden going to get the share class thing. Are they going to just immediately do a heartbeat trade and boom, all this is gone?
Right.
Right. So they've made some good regulation lately, right? The ETF rule 6011, great. 18F4, it's not easy. It's the derivatives rule, but it definitely broke up the monopoly of only two companies being allowed to do leverage, and it put a real strong cap on how far you can go, right? The odds that we ever see another 3X product right now under current law is pretty much zero. So they've made good decisions. I think they were forced also to finally capitulate on crypto, although that process was the most ass backwards thing I've ever seen in my life. But and I just don't think they're going to rush into the share class thing because there's a lot of unknowns, right? And they've just got to be careful. And I worry that if they did rush and like the story, I know who's going to come out. There's always that one reporter that likes to beat up on ETFs. I think they're in London. They'll be like, "Oh, SEC did this, and there was new tax loophole for mutual
Right.
funds, and it's going to be just messy." I don't want a messy. There's no loophole in an ETF. It's taxed the way it should be. You buy something, you should be taxed on what you buy, not what the cost basis is of somebody else. And investors should be incentivized by our government for good investment behavior. Buy and hold and sit down. If you want to go speculate, if you want to go use a leveraged micro strategy, go be it, but you're going to pay taxes or and you got to understand the risk.
Yeah. No, that makes sense. And one of the other things I want to ask you about that's like unrelated would be like, at least thinking about the ETF space, there's a lot of single issue funds or small fund families that might have ETFs that are, 40, 30, 50, $70 million. Do you see a world where you start to see some like M&A and consolidation and roll up in the ETF space? Like, it's not going to be as clean and easy as like all of the roll ups and M&A that happen in the actual wealth management space. But I could see a world where now that there are so many ETFs out there, where private equity is going to start to take a little bit of notice, and there might be that consolidation and roll up. Is that on the table at all? Are people having those discussions?
Yeah, somebody with 40, 50, 60, 70 million in a single ETF, the first thing I want to say to them is congratulations. That's the hardest thing to get done, right? Like that first 40 is so much harder than the next 100, 200, whatever it is, right? So like they should first take a victory lap because they're probably very close to break even. And then you're just kind of waiting for the cycle to come to you and your shiny object moment, right? Like the best thing an ETF issuer can do to succeed is survive, right? So that's the first part. Second part is we see a lot of groups like that come to us and want to join the Tidal platform because they did a lot of work to get there, right? And they want a partner to go to the next level. Like one thing that Tidal does that we didn't talk about earlier is we do finance a lot of our clients. About 40% of our clients, 30 to 40, have elected for us to be a partner with them. And it's pretty straightforward and simple. We cover X% of the expenses, including marketing and any expenses they have with the business. And we get that same percentage in profits, right? So it's the simplest pari passu deal you can. So we get a lot of people who get to those levels that you described and say, I want to take a little risk off the table, but I also want to be on a platform where I can leverage other things. I think that works better than fully buying it. There's going to be, let's just call it what it is. AXS tried exactly what you just described. I don't like to speak ill of anyone, but it doesn't look like it's succeeded very well, right? Because they've just recently completely pivoted away from that, right? And there hasn't been the economies of scale. ETFs are sold by their champion. We always want to keep the champion with it, right? So I like our little, hey, you want to come join the Tidal family? Great, but it's still your fund.
Mm-hmm. So I'm going to ask this question, selfishly. Our fund has, a couple year track record. It's done fairly well. We've got assets in the door. We're above break even. We're approaching that 3-year mark. So you've got I'm sure you have others on your platform that are in a similar situation. I feel like that 3 year is almost a pivot point. What advice, I'm just going to ask it selfishly. Sure. What advice would you give me, right, at approaching year 3, you're past break even, you've had some success. What do we need to be doing and looking forward to start getting that kind of secondary level of distribution?
Yeah. So number one, don't stop all the other stuff, right? These podcasts, like Meb's built a $2.8 billion ETF company with his main thing being a podcast, right? So find your niche, get to your audience, tell your story, right? Don't stop any of that. I can say that I did this paper last year. Cynthia and I wrote a paper. I think it's 68% of all ETFs that close do it in the first 2 years, right? Then you go to year 3 and the number drops massively. And there's a reason for that, because it's usually 3 years is enough to hit one of your cycles and get to the break even and things like that. I see a lot of people get excited. They go, I hit my 3-year number. Now Morningstar is going to rate me. There's some value there. It depends on the product you have. There are a lot of platforms that really don't want to talk to you till you're 3 years old. So there's some value there as well. I don't think there's a major change in what you should be doing. I think it's do what's been working and keep trying new things, right? Just continue to iterate. At Future Proof, I met a bunch of these social platforms, Blossom, Wolf. We're doing some things with Weeble. Being able to meet the investors where they are and not necessarily wasting all your time at Schwab Impact talking to the 20 guys who are never going to do anything other than VTI. I mean, that's the definition of insanity, right?
Right.
It's funny. It seems to me like many of the advisors have adopted this VTI and chill. I don't want to fight that battle, right? I want to keep getting my content out there, keep getting our stories out there, keep finding things that people are excited about. And then eventually the advisors get 10 calls from their clients saying, hey, over in my Schwab account or my public account or my SoFi account, I'm buying this. Why don't you have it? Oh, that's not approved on our platform. Oh, why? We haven't done the due diligence. Okay, sure.
Right.
And they're looking at it going, but it's $1 billion fund, right? Right. So yeah, I'm not making any friends at the wires with this discussion.
No, that's fine. They probably won't.
Shoshana, guys, I love you guys. I know there's institutional product that you support. Jabbar, I love you.
So good. Well, Mike, I always appreciate our time together, and this is, it's always good to get an update about, what you guys are doing and what's going on in the industry. So again, thanks for your time. And where can people learn more about Tidal if they're out there thinking about starting an ETF?
Yeah, so the Tidal ETF Masters, it's kind of hard not to find us. We're all over social media. The website is tidalfg.com. That's the easy one. You go there, there's this nice big blue button that says build your ETF. It'll take you through an RFP and get Brittany or somebody on our team, Matt, to call you back and walk you through the process. our first calls are very consultative. We're not a hard sell. If anything, we're trying to push you away from doing it and making sure that you know how hard it's going to be.
Yeah.
I like Wes always says, his first call is to scare the shit out of them and see if they're going to come call him back a second time. I don't quite go that far, but I'm not as militant.
Right.
Yeah.
That's a good word.
Yeah. Tidal's easy to find, and we'd love to help you launch, grow, and operate an ETF.
Well, again, Mike, thanks so much, and good luck with the rest of the year with the remaining launches. And I'm sure I'll catch you on the conference circuit as that starts to kick up in 2025 again.
Sounds good.
All right, man. Thank you. Bye.